Now let's analyze the liabilities part of the balance sheet and the equity part of the balance sheet, and get into each component within that and understand in detail. So now let's look at the second part of the session, which is to learn about liabilities and equity. And liabilities and equity are to be considered in a way that the total of liabilities and equity should balance, as a name in balance sheet suggests. It should balance with the total assets that we saw in the previous session. Liabilities and equity are very similar to our day-to-day life, what we face. Think about it, like in a home loan, when we buy a home, we put an equity part of 10%, 20%, 30%, and that is our money that we put in. Similarly here, equity is the amount that the owners of the business put in, and the liabilities is that covers the remaining amount which is required to fund the assets. So put together, liabilities and equity is used to own the asset, or is to buy the assets that the company requires. So to put it in a very simple way, assets are what the company owns, and liabilities and equity is what the company owes. And liability is part of the balance sheet. And let's look at each term here. There are two main parts to it, which is the current liabilities or short-term liabilities, and the non-current or long-term debt, which forms the other part. And you could see in the screen, this is from Walmart's balance sheet, the three parts: short-term liabilities, long-term liabilities, and equity portion in the balance sheet. Put together, the total liabilities and equity is $198.8 billion. Let us see each term within this liability session. The first part of it is a current liabilities, which is short-term borrowings. As the name indicates, this is the short-term debt, the loan that the company takes from banks and financial institutions, which the company uses for quick financing to fund immediate needs like working capital needs. Usually the long terms are tenured for less than a year, and that's why it's called short-term borrowing. And for Walmart, particularly this consists of commercial paper and lines of credit. And short-term borrowings outstanding for Walmart as of January 31, 2017 was $1.1 billion, and they took it at interest rates of 6.2%, which is usually higher than the long-term debt interest rate that the company pays. And another important factor is short-term debt is a very critical measure of the liquidity position of the company and indicates the ability of the firm to sustain near-term capital needs. Rating agencies looks at the proportion of the short-term debt to assess the overall liquid condition of the firm, liquidity profile of the firm. And short-term debts can be sometimes very dangerous, because especially for small firms and medium firms who are really struggling to procure the capital to meet the working capital needs, short-term debt forms a critical part. And if the business conditions worsen, economic conditions worsen, sometimes the interest rates could go high, and meeting the short-term demand might become really difficult for these businesses, and that can impact the liquidity position of the firm. Next important thing is account payables. Account payables, as the name says, these are payables to the suppliers and creditors for the business. Basically, any business we take, the suppliers provide raw materials, finished goods, outsourced products back to the business. Multiple other depending on the type of the business, different type of products are supplied by the suppliers, and the businesses usually take advantage. Sometimes they have higher negotiating power in terms of credit, and they can negotiate and get a longer gestation period to pay it back to the suppliers, which can really help with the businesses on their cash conversion cycle, whereas the suppliers might be cash crunched when such scenarios happen. So account payables are a really important factor of the current liabilities, and this forms part of the liability section of the balance sheet. So accrued liabilities, let's understand what they are. They are expenses incurred by the firm which are not been paid yet and as of date, and it's recorded as accrued liabilities. These are unpaid amounts. For example, it could be wages of employees or bonuses that are yet to be paid for the employees but which are accrued, and also the taxes which are accrued, which are payable, and also the rents, for example, which are unpaid. So there's a snapshot view of balance sheet of Walmart, and you can see that the accrued wages is quite high for Walmart. The sheer size of Walmart's balance sheet is causing that high value, which is $6.1 billion, and the total accrued liabilities is $20.6 billion, quite an amount. The last part of the current liabilities include the long-term debt portion of it, which is due within 1 year. So as the name says, the current portion of long-term debt, which is amount of principal that will be due within 1 year of the date of the balance sheet. And in this Walmart's case, it is reported and as a value is around $2.2 billion. So that brings it to the end of current liabilities or short-term liabilities. Now next we will see the long-term liabilities portion of the balance sheet. First component is the deferred taxes, which is a tax liability which is created primarily due to the differences between the book tax and actual income tax. A deferred tax liability keeps into account the fact that the company in the future will pay more income tax because of the transaction that has happened in the current period of current time period. For example, the installment sale receivable. Now this could also arise due to the differences in the method of accounting of depreciation by different firms. In Walmart's case, this is due to the depreciation, and it is the deferred tax liability is close to $9.3 billion. So the long-term liabilities, which also include long-term capital leases, primarily long-term capital leases, Walmart has leased most of its retail stores or some of its retail stores and even warehouses for that matter, and they are reporting a total long-term capital leases of around $6 billion in 2017. Typically they are very advantageous to lease because there are a couple of ingredients in terms of the key advantages are, leasee is allowed to claim the depreciation on the asset, which reduces the taxable income, and also the interest expense also reduces the taxable income. Long-term debt, this is the main portion of the long-term liabilities, which are as the name says, it is in the balance sheet the long-term debt which the companies took or the firms took as loans from financial institutions and banks, and these are payable more than 1 year of these are due within more than 1 year of the term, and long-term debts are taken by the firm to meet expansion need, high capital expenses and capital investments like new plant setup, buying a large scale machinery, or setting up a factory building. These are all type of long-term these are type of long-term assets, and to service or to buy these assets or to set up these assets, the company would have financed from banks and financial institutions at certain interest rates, and these debts or loans form portion of the long-term debt. And in balance sheet, Walmart's balance sheet, we could see they had around $36 billion of long-term debts, and the company taking debts usually will have to pay an interest rate when repaying the borrowed amount. The long-term debt examples are usually bonds payable, long-term bank loans, pension liabilities, customer deposits, etc. Now average borrowing rate for Walmart was around 4% in 2017, and typically we can see the breakdown of the unsecured debt and total US dollar denominated, euro denominated, because Walmart has taken debt across the continents, and we could see that the total the average rate of interest rate that the Walmart pays with the maturity dates, and this breakdown helps us understand how the loans are categorized and when are they due and what is the interest rate that Walmart pays. So this forms the cost of capital also, the interest rates that is reported here, and when companies are reporting the cost of capital, they should ideally try to make, the main reason why the business exists is to make more money than the cost of capital. They should make a return on the invested capital higher than the cost of capital, along with growth, which will create significant value for the businesses. Now that brings to the end of total liabilities, both short term and long term. Next, we will see the equity portion of the shareholders' funds, which is part of the next section. So equity or shareholders funds represent an ownership claim of the firm. This is the portion of the balance sheet where there is an ownership claim over the firm. For example, if we had bought so many shares of Walmart, it really indicates that we own a certain percentage of the firm in terms of ownership, and the capital, the certificate of ownership used to be given initially. Now it's all electronic, although it is not issued segregated, but now it's in the dematerialized form. In your equity account, you could see number of shares and what portion of what amount that translates into. So the total outstanding shares are the number of stocks that has been issued by the firm, traded in the market, and has not been bought back by the firm. Now, typically there are two types of stocks issued. One is a preferred stock, other is a common stock. The preferred stocks, common stocks, retained earnings, paid in capital, all of these forms part of the balance sheet, equity portion of the balance sheet. Now, when an investor gives a corporate money in return for the part ownership, as we discussed, the corporate issues the ownership interest back to the shareholders, giving them certain amount of shares or so-called stock, capital stock, to denominate the ownership interest of the shareholders. Typically, the par value is recorded in a different shareholders' equity account in the ledger. Any proceeds that exceeds the par value are credited to another shareholders' equity account called paid in capital, which is in excess of the common stock. In Walmart's case, it is the capital in excess of par value is around $2.3 billion. Retained earnings, as the name says, these are earnings which are retained by the company in cumulatively, over since the date of incorporation of the company. Most often, the companies retain the earnings to plow it back to the business to run the business operations or to meet the capital needs over the long periods of time for the future growth. Now, whatever amount is not retained by the firm is usually given back to the shareholders in the form of dividends, as we had seen earlier, and they get the dividend yield, which is given to the shareholders. Now, in Walmart's case, we see the total equity is around $80.5 billion. You add the total equity to the total liabilities, you get around $198.8 billion, which is in proportion, or which is equal to the total assets we saw, right? So they are in balance. That's around $198.8 billion again. Another term which we did not delve in detail is the preferred stock. So common stocks are the regular stocks which are given to the shareholders and in return for the ownership, whereas preferred stocks are a little different. It has a nature of both debt and the ownership claims on the company. The preferred stockholders get a precedence over the common stockholders when they receive the fixed dividend which are paid, and also it's a hybrid instrument, so they also get an option to convert into a common stock when the market conditions are in up cycle, and so that they can get benefit from the up move in the share price. So that is the preferred stock portion and common stock portion. So this brings us to the end of the total liabilities and equity portion of the balance sheet and the assets part of the balance sheet. So as said in the introduction, balance sheet is a very critical component to understand the health of a company, and annual reports are a great source to understand and read the balance sheet. And annual reports are typically, it expands out across all components of the balance sheet, and in addition all the details that is required for an investor to understand. So it's very important to read the annual reports as well as the balance sheet. Hope you found this whole session informative. Thank you.